Hello and welcome to Views from the Market, Midmarket Private Equity and M&A in Canada. My name is Mario Negro, and I'm a partner in the Private Equity and M&A group at Stikeman Elliott. For today's podcast, I'd like to welcome my partner, Jeff Elliott. Jeff is a partner in the Funds and Securities Regulatory practice here at Stikeman Elliott. Jeff, thank you for joining us and welcome.
Thank you, Mario. My pleasure. Nice to be here.
Jeff, obviously, when we talk about funds, we're talking about private equity funds, and I'm excited to have you here because I find that in some ways you kind of are the barometer for the evolution of private equity funds and search funds and all these investment vehicles, because they kind of all have to start by your door before they go out to market. So I'm excited to kind of spend some time talking about that today. But before we do that, let's talk a little bit about yourself. We always start the podcast with asking a bit about you and your history, and then we'll jump into talking a bit about your funds practice.
Sure. So I'm lucky enough, I think it's fair to say, to be a Stikeman's lifer. So I've been here for, call it 25 years in various capacities. Started my career as a public M&A lawyer, did private M&A, capital markets work. And then in the last, call it 12 to 15 years, I've really started to concentrate on funds and fund formation, as well as securities regulatory work, which the two kind of go hand in hand, particularly for our larger fund sponsor clients. But those two buckets of work are what I really concentrate on these days.
The goal of anybody who does these kind of private deals, Jeff, is that everybody wants to get to that point where they create a private equity fund, and that construct has now become kind of like the dominant one for private capital and doing M&A deals over the last 30, 40 years, particularly in the US. But when we talk about the growth of funds and their evolution, there's so many angles to it. I wanted to get your thoughts in terms of what you've seen in the last 15 years in your practice in terms of the evolution of private equity funds. And obviously we'll get to things like search funds and these other alternative investment vehicles. But I wanted to start from there. Just generally speaking, what you've seen in terms of the evolution of these funds in our marketplace.
Yeah, and we're lucky we've had kind of a front row seat as to the evolution of private equity funds, particularly acting as counsel or co-counsel in respect of the large household name type sponsored funds out of the United States in particular. So we've seen the evolution of fund terms and also, more importantly, I guess, the evolution of fund structures. And you kind of alluded to it a little bit. We've gone from the single main fund and perhaps a parallel vehicle or an alternative investment vehicle attached to it to a whole host of other vehicles within the structure, co-invest vehicles, as well as continuation vehicles and the like. So it's been a real evolution. And as is often the case, the US marketplace and to some extent the European marketplace have kind of led and have been the originators of these types of structures. And now we've caught up in many regards in the structures that we're using and seeing in Canada, both in the private equity sphere, as well as in the venture capital sphere as well, which I do a little bit of work in, and sometimes in the real estate area as well.
And if you were to say, and I'm going to start from the private equity sphere, then kind of look at some of these other additional vehicles that have evolved from it. But from a private equity point of view, Jeff, like what would you say is you've seen as the kind of evolutionary changes that have happened, both from a structure or whether, the key things you've noticed in your practice, that things have changed from the kind of traditional 2% and 20 fund. What have you been seeing in terms of its evolution?
I mean, the fund terms, as I said, have matured, but I really think the general construct of the 2 and 20 is still alive and kicking. But there's obviously been variations on the theme in terms of fund terms, and also the advent of more open-ended funds in the private equity sphere, which is something you probably wouldn't have seen 15 years ago. And then, as I said, the various other structures that have been adjuncts to kind of the main fund and the continuation vehicles and the co-investment vehicles, as well as now in the last, call it 5 to 10 years, we're seeing a lot more action in GP stakes and secondary types of transactions. So there's been a real ecosystem or market that's developed around both the investor side of things, as well as the fund and fundraising side of things and the investing side of things. So it's kind of A to Z now in terms of vehicles and servicing the marketplace.
I know you talked about the open-ended funds, and obviously we're used to the kind of 5 to 7 year investment periods of private equity funds, and these funds are lasting 10 years. I've heard all kinds of stuff, but I mean, how open is open, Jeff, in terms of how long some of these funds are now setting themselves up for?
Yeah, some of them have no defined life. Some are 15, 20-year life. So what's fun about that from our vantage point as the people who help structure them is it's kind of marrying both the private equity world with the hedge fund world in many ways. So you have features of private equity, obviously, because of the types of investments that are being made, but also some of the mechanics within the fund are akin to what you'd see in a hedge fund, like valuing NAV and allowing for continuous subscriptions and redemptions. So that's interesting from a drafter's perspective or the legal practitioner's perspective.
On continuation funds, Jeff, obviously they're very popular in the US. This idea of kind of rolling over an asset instead of selling it into a new fund to kind of continue owning it with a kind of new investor base. Are you seeing a lot of it in Canada? Anything in particular you notice in Canada where you see these continuation vehicles? Is there a sector? Is there a particular type of private equity firms that like them? Or are they as active in Canada in terms of an option as they are in the US?
I think we're lagging. We're several years behind the US and Europe in terms of the use of continuation vehicles, but they're certainly there. And you see them in the mid-market space for sure. And, in some ways, continuation vehicles get a bit of bad press because the critics will say it's just the sponsor not able to affect a good exit of the underlying investment. But in many instances, it's not that, but rather it's wanting to keep a gem, right, and continue to polish it in another vehicle is kind of the way I look at it. And those are the ones that I've typically come across lately. It's not so much an attempt by the manager to offload the not so good investments, but rather an attempt to hold on to the really good ones.
If I know that with the evolution of the kind of the concept of the private equity funds, we've seen different variants of it, whether it's the venture space and the search fund space and these kind of other vehicles that exist out there that are kind of like private equity, but take it on their own into their own angle, particularly in the middle market. And tell us a bit about that evolution from these other type of funds, particularly from a Canadian perspective. I mean, I know you've been kind of working and leading the fronts on a lot of these kind of newer type funds. Holdco structures is another one we're starting to see now. Any of your sense of what you're seeing on that front?
Yeah, and we are seeing a lot more activity with those types of structures. One in particular that's near and dear to your heart, I know, and has become very near and dear to mine is the funds of search funds, which are aggregator vehicles or funds that invest in search funds and search funds in turn investing in operating companies. And we've been lucky enough, a lot through your efforts, Mario, we've been lucky enough to represent, I think, all of the sponsors who've done funds of search funds in Canada. And through those representations or through that representation are starting to see the evolution of that marketplace where people are now starting to do alternative investment vehicles as part of their structures, but also more importantly, things like co-invest vehicles. And people are talking a little bit about secondaries and continuation vehicles. So it's kind of following the same evolution that we spoke about in the larger PE sphere is now coming down to, the mid-market or the lower mid-market and the search fund or fund of search fund area, which is all great.
One of the things, Jeff, I've noticed in our time is when I started practicing, the idea of creating a private equity fund almost had a kind of minimum threshold. It was very hard to create a private equity fund if you didn't have, back then, I used to feel like it was 150 or 200, but you really kind of needed critical mass to get the. And what's interesting about the evolution of funds is you and I have worked on many of them. People are now creating private equity funds with as little as 20 million or 30 million. And obviously there's tensions on management fees and the ability for these things to actually have the resources they need to kind of do the everyday work. But I guess, how are you seeing people evolve? Like, how's the evolution of these kind of smaller funds evolving in terms of managing things like fees? And because we're seeing more and more of them, and frankly, it kind of reflects, I think, our marketplace where it's so hard to get this private capital into funds that people are willing to try and make them work even when they're smaller.
And we have seen the smaller sponsors, all of whom, in my experience, have been quite sophisticated. And I think that has allowed them to take on the task of creating a fund with a lower AUM, at least for their first fund, which may not have been viable in the past. So we've got people who are, as I say, are sophisticated and understand the landscape and are willing to roll up their sleeves and kind of do A to Z for their funds. And of course, with the smaller AUM, there are fewer investments, et cetera. So it is a little bit more manageable. And I think as the ecosystem has evolved in Canada in particular, now there are, many more service providers that can assist and can assist on an economical basis. So I think that has allowed the smaller fund sponsors to get off the ground, with the hope, of course, that one day they will be raising the $100 and multiple $100 million funds as they evolve.
When you think about where the space has come from and kind of where it's at and where it's going, are there any trends that you see from a fund formation or fund structure point of view that we should kind of keep abreast of, or that I think we'll see more of? I know one for me that I do want to ask about is people are now starting to create these holdco structures, we call them, which is really just that idea of creating a small capital raise to invest in only one subsector of one industry, which I think has really taken off in the US, but I think now is starting to arrive here in varying forms. So I wanted to get a sense from you if that's something you're seeing and other things like that. And also, what should we expect as the evolution of these funds continues?
Yeah, the holdco structure is an interesting one. And we have seen several players set up holdco type structures using limited partnerships sitting at the top of the chain. So kind of mimicking in many ways the fund type terms with some obvious variations. So using the term holdco is a little bit of a misnomer because it is much akin to a fund/limited partnership. So that's one area that I think we're seeing a fair bit of evolution, particularly with those who are familiar with the search fund space, because I think that's really where the holdco structure has evolved from. And then more generally, I think we're seeing a lot more action in secondaries, GP-led secondaries, for example. And I think that is a function of the fact that some sponsors, not so much in the mid-market sphere, but maybe with larger investments, are having trouble meeting the liquidity needs of their investor base. So that has generated a lot of action in the secondary market.
When you think about where your practice has gone from, Jeff, in terms of the evolution of these funds, and you look at the future, is there any particular type of structure terms you think we're going to see more of, or is going to become more popular, or whether it's from the US or from other jurisdictions that maybe hasn't arrived here?
Yeah, I do wonder whether or not there is going to be more of a focus on long-term hold type funds that we spoke about earlier. I think that is something that many people are interested in, particularly when you're talking about lower mid-market type investments, where there's a desire to hold on to these investments for a prolonged period of time and not on sell them to larger private equity shops, but rather to have within the holding period 1 or 2 or 3 bites of the apple, so to speak, in terms of the growth of the underlying investments. So I think that is something that is interesting and that a number of people are talking about. So I wouldn't be surprised if we see some more action on that front, which would be great.
Jeff, I want to thank you for joining us and giving us your perspective. Obviously, your practice is itself an evolution of our marketplace, and it's exciting because we're seeing more and more of these different vehicles. And I mean, obviously, I'm self-interested. I want you to be busy because if you're busy, then I'm busy. So I'm excited that you're seeing more and more creativity on the fund structuring side, and I appreciate you taking the time to kind of tell us a little bit of what's happening on the fund structuring side.
My pleasure, Mario. Thank you very much.
Thank you for tuning into Views from the Market. Stay updated with the latest episodes by subscribing wherever you find your podcasts or visiting stikeman.com/viewsfromthemarket.